Welcome back to ASX Options, it's Jonathan here. So today we're going to be talking about the payoff diagram, and this is really important because we need to understand what profit and loss we can potentially have from different option strategies. So what I mean by this is that for a certain strategy, we're going to have a certain potential payoff, and you can draw this with the payoff diagram that we're about to see now. Now, you can focus on the most complex strategies, but I prefer to break everything down into its base components, and that's the call and the put, which we've already been through. So today we're going to work on the basics, and we're going to focus on them and really nail them down. Okay, excellent, let's jump in. So as we've just said, the profit and loss, this diagram represents the possible P&L of the options contract. So let's jump into an example. So we have a call option with a strike of $30. So imagine that stock price, it's at $30 right now. Okay, and then we've got this dispersion in the stock price, these possible outcomes. So we're centered around this $30 strike here. And now let's try and picture some of the examples of our possible payoff, right? Our P&L. Now remember that if any stock price lands below $30, we end up with zero. However, if the stock price landed at 40, then we'd have $10. If it was at 50, then we'd have $20. So this call payoff diagram is just trying to represent what is the potential payoff for all these different outcomes. So it's traditionally viewed like here, with the stock price here on the x-axis and the profit and loss on the y-axis. We had it inverted on the other side. So here, remember, if we have a strike of $30, it's zero, because the call payoff is the underlying price minus the strike. So now on the other hand, let's imagine a real example and that it costs $5, okay? Because option contracts cost money. A seller isn't going to give it away for free, that optionality. So this option costs $5. How does that impact that payoff diagram now? So, well, now the buyer's payoff diagram has actually shifted, okay? And it's shifted by the amount that he's had to pay for the option, so $5. And that's a debit to the buyer's account, right? So now that means that he's $5 as soon as he purchases the contract. And you can picture now the stock price is at $30. He needs it to move above $35, right? 30 plus 5, $35 to break even. So $35 is his break even point. Whereas the seller is completely the opposite. He starts off with $5, okay? When the underlying starts at 30. Now, if the stock price starts moving higher, then he can start to lose money on this trade. However, if the stock price moves lower, then he can actually retain his premium of $5. So that's the $5 credit initially that he gets to himself. So put options, so this is the opposite. So again, we have our stock price, $30 strike, but the payoff is completely opposite. So any price that ends up with the underlying above $30, it's a $0 payoff if you hold the option contract. Whereas if it falls below, you can see the lower below 30, the stock price falls, then the larger profit you'll then have. So again, here's what it traditionally looks like with the stock price on the x-axis and the profit on the y. And here's our $30 mark. If the stock price lands anywhere above that, it's $0 payoff, and below that, linear. So let's picture again that the option costs $5. So now, to the buyer, his break even has actually now gone lower. So from $30 where you have a $0 cost basis for entry, now we have a $5 cost basis. So that's the debit to the buyer again, and his break even would be 25. Whereas the seller's payoff diagram, again, is completely opposite, right? He gets to maintain this $5 credit if the price lands anywhere above 30, and he can still make money at the break-even point of $25, okay? and then he'll start losing money below there. So in summary, we have a $5 call option with a strike of 30, then here's the strike price, and our break even is going to be higher than that at $35. Now, quite the opposite way, the put option with a strike of 30, the buyer is going to have a break even lower at $25. Hey guys, I hope you enjoyed the video. If you like this video, please go ahead, hit the like button and subscribe if you want more content. Okay, cheers.